Welcome, everyone, to another weekly episode of The Wealthologist. I'm your host, Chris Hobart, and today I want to delve into consumer spending, specifically the December 2023 edition, where recent data shows us that people are spending like there's no tomorrow, regardless of interest rates or anything else. In fact, shoppers kicked off the holiday season this past couple of weeks with a huge bang. There was a record 200 million people that visited stores and searched websites from Thanksgiving Day through Cyber Monday, so very short period of time. And that's an all-time high, and it wasn't just foot traffic. The total amount spent also broke some big records, which increased from last year by 7.5%. In fact, for the first time in 2 years, growth is coming actually from increased demand rather than just coming from higher prices, which that's an important thing to note there. The average consumer is expected to spend about $1,652 on the holidays this year, which is a 14% increase from last year. So no matter how this data is sliced and diced, Americans, we are just spending. And that surprised a lot of economists, as well as investors, who kind of expected a weaker start to holiday shopping this year. In fact, given all of the different headwinds that are facing consumers, many are even asking, where is this money coming from? And there's three reasons that likely explain this trend. First, the job market, it still remains strong. There's some different sectors that are showing some weakness, but despite stories of layoffs, there are still 1.6 jobs for every person that's looking. The unemployment rate is 3.9% and drops to 2.2% for workers with a bachelor's degree or a higher education. So strong job markets lead to higher wages because employers must compete to keep the talent. Now, wages aren't the only thing that's rising, but they're doing so faster than inflation, which is important. Bigger paychecks make consumers more confident and also help them loosen purse strings and spend more money. Now, second thing I want to point out, consumers are sitting on a lot of dry powder. There's still an estimated $433 billion in excess savings remaining from the 2020 to 2021 stimulus programs. Now, this has fallen since the peak, which was back in August of 2021, but it's still close to $500 billion of additional cash that's sitting in bank accounts waiting to be deployed. Now, a third point I want to point out is that the average credit card interest rate has absolutely exploded to an all-time high. Now, this has fueled the popularity of creative financing, which kind of sounds like what we've seen before, which is buy now, pay later, kind of putting things on hold to pay. The buy now, pay later lets buyers spread the purchase cost out rather than incur all of the cost at once. So some of these buy now, pay later plans, they're offering 0% financing for several years. And retailers like this buy now, pay later because it's cheaper than credit card fees, and it also encourages more spending, which retailers love. U.S. holiday shoppers spent an estimated $940 million using buy now, pay later services on Cyber Monday alone, which is a staggering increase of 43% from last year. Now, shoppers using buy now, pay later services spent $598 on average on Black Friday versus $452 among those who didn't use a deferred payment method. So from November 1st to the 27th, buy now, pay later, that's actually driven about $8.3 billion, which is up 17% year over year. And November is expected to be the biggest month on record for this type of payment method. Consumer spending, like I mentioned before, it fuels about 70% of the U.S. economy. That's why this time of year, it matters a lot to Wall Street. And while the data so far have been impressive, it's not perfect. Never is, right? For starters, not everyone is spending more. Wealthy consumers, as we would imagine, they spend the most because they have the most to spend. And this year, it's no different. They've got more, deeper pockets. But other cohorts appear to be spending less on a relative basis. Furthermore, the data also suggests that demand, well, it correlates more with the discount size rather than specific categories like apparel or electronics. So what does this mean? It means consumers are chasing the best deals more than popular discretionary items like Furbies and Beanie Babies, right? Lastly, consumers may have used Black Friday and Cyber Monday a little bit more for delayed necessities and less for what we'd call discretionary purchases than in the past. So, for example, if a dishwasher broke last summer, the owner may have waited until the holidays, knowing that there may be sales or a better price available. So if that's the case, some of the spending that we're seeing, it might actually be robbing Peter to pay Paul type of scenario. So if we add all of this up and consumers have money to spend, some trends, like a strong job market, they're good, while others, like rising credit card default rates and rising interest rates, those are bad. But the net result right now is undoubtedly fueling economic growth. So, for example, when we think about the S&P 500 operating earnings per share, well, they're now on pace to set a new record high. And when we think about this, much of this can be attributed to consumer spending alone. The bottom line, well, it's that investors really should never underestimate the ability as well as the willingness of Americans to spend their hard-earned money. This year, it may prove to be no different than what we've seen in the past. Now, if you've got questions about this or wonder how this impacts your investments or what this might mean for you, give us a call. We're always here to help. That's all for the Wealthologist. We'll see you next week, same time, same place.